Home loans were the toast of the season just about a year and a half ago. We were being told that home loans were at very cheap rates, interest rates were historically very low, and this was the time to go and grab your dream home. Interest rates for a home loan were in the range of 6.5%, 6 to 7%. Today, it's gone up to 9.5%. What does that mean for how long you will pay this home loan? If you look closely at the math, it becomes a little scary. Suppose you were 35 years old when you took a home loan just about a year ago for 20 years. With the idea that you'll prepay. Most Indians prefer prepaying their home loans, but it takes time. As of today, you could be paying your home loan for as long as 50 years because of the increase in interest rates. What banks tend to do is that they tend to increase the amount of time you have to pay that home loan for rather than increase your monthly EMI. That means you could be paying off your home loan well into your 80s. In this example where you took a home loan at 35, how does that actually work? Isn't that dangerous for you as a borrower, dangerous for the bank? Clearly, you cannot continue paying your home loans in perpetuity. And are you now in a debt trap? My colleague Ankur Mishra is joining us first to talk about why exactly this is happening.
In a higher interest rate scenario where Reserve Bank of India has increased repo rate by 2.5% in past 1 year, if your EMI has not changed, you should go and check. What we have understood is that many times lenders have increased the tenure of your home loan, but the EMI remains the same. Now, why the lenders are doing so? This has happened because in the current scenario, lenders want that the customer's monthly outgo should not be disrupted. That should remain the same. And otherwise, he can choose to increase the tenure. So the important thing here to note is that you can choose between monthly outgo of your EMI or increasing the tenure. Even if you have received messages or email from your lender without the consultation which has been done from you, you can definitely go and check with bank, and that adjustment can be done. Meaning you can choose to increase your EMI rather than increasing your tenures, because many of the customers have complained that the tenure has been increased more than the repaying capability or the repaying tenure which is possible for a customer. For instance, if a customer has taken a loan in the age of 35 years, if the 35 years extension happens for the home loan, that becomes 70 years or even more in some cases. Therefore, the solution to this problem, if at all you're facing, is go and check with your bank, and if bank doesn't solve it, you should go and complain to the ombudsman within 1 month.
All right, so Ankur has laid the basis of our conversation there. Now, the question is, of course, if people could afford to, they would prepay their loans. Like I said, most Indians prefer to prepay their loans. If you can afford to, you probably will choose a higher EMI. What happens if that's not an option? What is the way ahead? And are we looking at the beginnings of a bubble? Because remember, the underlying asset for banks is that home on which you have taken a loan. Those prices are not going up at that rate in this market. They are unlikely to match up with what the bank hopes to get out of you as a result of this loan they've given you. So how does the math work? Ramesh Singh, former executive director of Dena Bank, today on the show with me. Harsh Rungta, founder of Fee Only Investment Advisors, with us. I'm speaking with Prithviraj Srinivas, he's chief economist at Axis Capital, and A.B. Abraham of South Indian Bank. Welcome to all of you, and thank you so much for speaking with us today on the India Development Debate. Mr. Abraham, let me begin with your take. What are the numbers looking like? We talked about a 250 basis point hike, that's 2.5% over the last 1 year. If I look at someone who's taken an average of a 50 lakh loan and they're aged 35, is this calculation we're making correct, that they would be at this rate paying their home loans well into their 70s, maybe even in their 80s?
So let me come from a different point of view here and tell your viewers how it all works. So when the banks calculate the entire interest loan for the customers, how they calculate is they look at the income of the customer and they plug the entire EMI or obligation for all kind of loans to 50 to 55% of income. Based on that, an EMI is calculated when the loan is given. And based on that, a tenure is also fixed, say 20 years in your case, which you said 50 lakh, 20, so 35-year-old person, 20-year tenure is fixed for that customer. And the EMI is given. Now the banks will always, when the interest rate regime goes up, will always like to keep the EMI and the tenure gets increased till the paying capacity or the working time limits of the customer. So say if his retirement is 60, so up to 60, the tenure can increase and maximum up to 30 years. So 20 years can become 30 years. After that, the banks will start increasing the EMI portion of that loan. Till that time, the customer can go to the bank and keep his EMI same as he has contracted at the time of borrowing. And then, and in case he wants to increase the EMI, you always can go and say that I don't want to increase the tenure, but go and increase the EMI and keep the tenure at 20 years. But the calculation saying it will go to 70 and 80 years is not a plausibility because the banks themselves will like to have the entire loan closed out by the working age of that customer. Now the question is, are they going to really be stressed on their income levels if the EMIs keep going up after a certain limit? But I said, when we do calculation and give that borrowing to the customer, we limit the entire the EMIs to 50% or 55% of his total income. That means 50% of his other income is always there to do his household income. Now, also look at from the point of view, if somebody is taking a loan, have taken a loan 3 years back, so the 50% or 55% would have been paid 3 years back, but he would have also got an increment or what his income would have increased in like next 3-4 years. So incrementally is 50%, which is started 50% of his household income.
May I come in, Mr. Abraham? What you're describing is the ideal situation. There are many people out there who don't fit in these boxes, who got an increase in income in the last 3 years commensurate to what the interest rate went up. It was the pandemic years. A lot of people lost their jobs or had a reduction in income. So this assumption is an ideal situation and is very disparate from what is really going on. There are people out there who have seen their tenure go beyond what would be their retirement age because there's a limit to how much your EMI can also go up. That situation is being reported widely. So we are in that situation right now. My question is that obviously it's not even possible for the bank to wait that long to get their money back. So then what's the plan? Allow me to go to Mr. Ramesh Singh on this and get his perspective on, whether we are seeing a case of where some people, not everyone, might be falling into a debt trap.
Good evening. Let me first clarify that banks do have given options to all the borrowers for a floating rate of interest and fixed rate of interest. All those colleagues of borrowers who have taken the fixed rate of interest of housing loan, for them there's going to be no impact on them because rate of interest will be fixed. It is the only floating rate of interest people who would have been now being suffering because of interest rate going up and they have to. But at the same time, while the EMIs are going up right now because of interest rate going up from say 6.5% to 9.5%. This situation will not remain years together the same rate of interest. Quite likely, what we have been seeing in the market for last couple of days, even the GSEC yields have come down by almost 20 basis points. And there are news in the market that maybe RBI will also have to stop, take a breather for going any interest rate hike. So if the interest rate next 1 year or so when start going down, that customer will also start getting benefit of that EMIs, which for now it must have been increased. But again, the customer also got the option to go to the bank and get this into a switch. No doubt, no customer with the floating rate of interest will now go to the bank and say, now make it a fixed because today's rate of interest will be fixed. So as such,
Mr. Singh, just a couple of things I want to clarify. Yes, you said that over the life cycle of the loan in 20 years, interest rates will go up, they'll come down as well. But it's, a well-known fact that interest rates on home loans don't go down at the same rate as they go up. Everyone knows that. And I'm sure you will admit to that as well. And you talked about fixed home loan borrowers. What is the percentage of fixed to floating? It's minuscule. And the reason is not because people don't want fixed loan, it's just tougher to get. It comes at a higher cost and it's not as easily given by banks. That's why you have so many people in this situation today, Mr. Singh.
I'm sorry, ma'am. You may be having the information. It is not that customers are not given these options. We always, every banker, my colleague sitting there from South Indian Bank will vouch for me. We are always having the option the customer to, before we sanction the loan, we make him understand the benefits and demerits of both the sides, rate of interest, fixed and floating. So this is not correct.
The option is not there, sir. Let me clarify. I'm saying it costs more. There's a heavier cost imposed on taking a fixed loan upfront. Isn't that correct? It doesn't cost you the same as a floating loan.
No. See, any house loan borrower will be charged any charges, say processing fee, other things, while shifting once. Even Reserve Bank of India has given every home loan borrower will be given one option once in cycle to switch over from fixed to floating or floating to fixed. It is not because he's going for fixed loan, that is why he'll be told he'll be charged. Only once he comes for changing his option, then only some certain fees levied.
Shungta, I'd like you to, throw some light on the situation over here. We've started with, point of view from two bankers and to get their side of the story. And I'm not pitching this as a bankers versus borrowers kind of a debate. We're trying to understand what happens because even for bankers, people with, no light at the end of the tunnel, an idea on how to pay their home loans is not a great idea. It's a scary situation for them as well. Tell me about why so many people right now are feeling stuck. And what's the way out for them?
So I think like any other thing, I think this story also has some element of distrust with bankers in this. This is one of those situations where I think the banks are right. I mean, first of all, I don't think fixed rate home loans, long-term fixed rate home loans, like a 20-year fixed rate home loan, I'm not aware of a single person who has ever obtained a 20-year fixed rate home loan in the last 3 or 4 years. So even any fixed rate loan we are talking of is fixed rate for a couple of years, maybe 1 year at most, or maybe 2 years. And then it gets into floating. I think that's problem number one. I think problem number two is that basically initially all borrowers go for floating rate because of the issue that you mentioned. Even the semi-fixed rate loans that are very, very expensive, and therefore every borrower at that time clearly opts for only a floating rate loan, and therefore has to pay the EMI.
Mr. Rungta, I think that's at your end.
It's not at my end. It's not my phone.
Okay, so whoever's phone is ringing, please mobile ko silent pe dal dijiye. Yes, please continue, Mr. Rungta.
So I think very clearly, when you get into a floating rate loan, I agree with the bankers that it's a long-term loan. You are going to see rates, the rates go up, and you are going to see rates go down. And we have seen that in the last 5-6 years, right? We have seen rates go up, we have seen it go down, and we have seen it go up again. And we will continue seeing that. Therefore, I agree with the fact that, over time, this is something that borrowers will adjust to, and very, very clearly. Hello. Okay. And so very, very clearly, I think borrowers will need to adjust to this. I think the issue is a failure of managing the borrower's expectations. I don't think any borrower is aware at the beginning of the fact that when rates go up, his tenure will go up. At that time, it is a facility given that, instead of your EMIs go up, because if EMIs go up, also borrowers will complain. Ki my EMIs have gone up, I cannot afford in the budget. So when rates go up, one of the two will go up, right? Either your tenures will go up or your EMIs will go up. Probably the lesser evil is that the tenure goes up, because at least your monthly budget is not disturbed. And they are right. You can always go to the bank and tell them, please decrease my tenure. And how do you decrease your tenure? I think either you pay off a part of the loan if your budget allows, or you agree to increase your EMI. Or third option is get your rates reduced. And I think that's an option very few borrowers exercise. Despite a lot of progress having been made, Tamanna, you are absolutely right. Rates don't decrease when market rates decrease, not at the same pace. Whereas they go up immediately when the rates increase. So I think this fact is what gives rise to a lot of misgivings. And I think this is something the borrowers can do, that if the bank is giving rates, giving home loans at lower rates to new borrowers, whilst charging higher rates, the same bank is charging higher rates to the old borrowers, I think they should shift banks. And I think that is the best way to take care of the tenure or the EMI issue. So I would say that first option, reduce rates, because that's the least painful for the customer, most painful for the bank. Other than that, you will either have to prepay a loan partly, or increase the EMI, or do a bit of both.
So Rungta, let me make the question more specific, because you've listed out options. What do you think is the best route to take right now? Because what happens with home loans is, especially those of long tenures, many people don't even check what's happening. Wo chal hi raha hai. Those mails and messages from the banks, people don't check. They know that money is going every month. This is a long-term asset we are creating, and it's just going on. This is also in part an awareness program. Go and check what's happened to your home loan right now. Do you know what interest rate you're paying? Do you know how much your tenure is increased? Go and read those emails. So we're trying to do that as well. And we're also trying to tell people what they should do. Is this a time to review? Prepay if you can. Increase EMI if you can. And you can't do any of it, because I've got this query. Should they then liquidate that asset and instead use that money to earn better incomes? Look at the FD rates right now.
You mean sell the home loan and sell the home and pay off the loan?
If it's not something you're living in or something like that, is that an option you should look at?
So I would put it in this order of preference. First, before you exercise any of the other options, get your rate reduced. That's the least painful for a customer. And I've told you what you can do to get it. Sometimes it is as simple. If you have been a good customer, you have been paying your bank on time, and they are overcharging you. And in most instances, the banks are overcharging you. It's as simple as making a call to the bank saying, I'm going to shift my loan unless you reduce my rate. And it's a very painless option. They may charge something and reduce your rate because they are giving that reduced rate to new customers. I think that's a painless option that any reasonably conscious customer should exercise. I think that is one thing that they should definitely do. I think selling the home to pay off the loan is a possibility, provided it is a property. But if you're living in it, it is pretty drastic. If it is an investment, definitely that is something that you should do. But I don't think that the only parameter there should be that interest rates have increased. There will be other parameters that you would look at. What is your asset allocation?
Right.
At this point of time, what do you want it to be? I don't think it is that easy a decision for you to do.
Absolutely.
Based only on interest rates, home loan interest rates.
Okay, Prithviraj Srinivas, the reason I was keen to get an economist's sort of take on this entire issue is because it goes beyond the stakeholders of the bank and the borrower. The bank obviously has that underlying asset. The borrower has to figure out, what works for them on a monthly basis and an annual basis. But my concern is this turning into some sort of a debt trap where people are not aware that they are possibly paying multiple times the value of their home in the form of this loan, and the value of the underlying asset is not increasing to that level?
See, I think the way we are looking about this is, look, I mean, a year ago, interest rates were exceptional, right? I mean, it's not the norm. It was a pandemic-driven low. If you look at 9 to 9.5% interest rate, what you're talking about average for bank lending rates, it's pretty much in line with what we had pre-pandemic and even pre-ILFS, if I go back, right? It's sort of where we were. So if you assume that, look, the economy has normalized, yes, inflation is high, and even if you say that over the next 1 to 2 years, inflation comes off, you're still looking at about average lending rates in the banking system remaining at about 9.5%, right, on a stable, steady basis. So to that extent, my sense is that I mean, whichever loans were given out, let's say a year ago, my sense is that most credit reviewers would have assumed normalization in interest rates, and therefore taken in would have seen whether the borrower has the ability to service the debt even when interest rates are normalized. So my sense is that I mean that is something that the credit process would have taken care of. So we are at a point where we are seeing normalized interest rates, and my sense is if the credit process was done correctly, then the households to whom the loans were given out, they should be in a position to service that debt. Yes, if the EMIs are not increasing and instead the tenures are rising, it does soften the blow in terms of monetary policy tightening and its impact on demand, right? Which is what RBI would want to see. There is still an impact because there is a bit of anxiety on the part of households that their tenures have risen and their debt service obligation is for a much longer period than they sort of anticipated, right? So it will still have some impact on demand. But my sense is that, I mean, that immediate debt obligation is not there on that household. So I would, to answer your question directly, I think to a large extent, if we had an exceptional sort of period when rates were low, and if loans were given out during that period, those loans would have been given out to borrowers who can service the debt even when interest rates would have gone back to normal. So my sense is that I mean I wouldn't be too worried, except there may be certain instances, and as my other fellow panelists have mentioned, there are certain recourse for them, where they can sort of go back to the bank and request for restructuring if required. But for by and large, for the general average sort of borrower who's taken on loans over the last year or so, my sense is that, the banks would have taken care when doing the credit assessment, right? I mean, I think they should be in a position to sort of repay. And lastly, I mean, I would say that, we are in a period where growth is likely to improve and inflation is going to come off. So actually, over the next 1 to 2 years, you should see real incomes improve across household categories, even for the bottom of the income pyramid, right? You can see rural wages go up. You can see that wages are rising even for textile workers, etc. So real incomes are likely to improve, and therefore debt servicing ability should also move up in tandem. So I think for by and large, it should not be as drastic as what you may be hearing from certain households.
Puts it into some perspective. Now, your debt servicing ability will go up, but does that mean that you should spend your money in servicing more and more debt? Because remember, that principal amount is not going down at that level. I want to come back to Mr. Abraham because we've got some more perspective on the story right now. Mr. Abraham, what is the proportion of fixed home loans that you have possibly given out, and how many of those were at the time when home loans were at 6.5%? Mr. Rungta is talking about how 20-year loans at fixed amounts are a rarity, and that is what anecdotally you hear as well. Can you shed some light on that?
Right. So the fixed loan proportion is very, very minuscule to the floating rate at this point in time. For banks, it is all repo linked. So as the repo changes up or down, the entire loan which you have booked changes. So fixed loan right now is very minuscule, and even if fixed rate is given, it is given for a tenure, 2 to 3 year to 5 years tenure, and then it can get re-benchmark. So it is not, even customers today are educated that they want it in a fixed, a floating rate, because they know that as the interest rate moves, their interest also changes with the same benchmark rate. So quite a education also happened from the industry on floating rate. So today, if you say, majority of other loans are floating rates, and at a repo linked, at bank level, it's a repo linked, or at NBFC levels, PLR linked, which changes as the benchmarks change.
Now to Mr. Singh on that point. The fixed rate at low interest rate for 20 years is more of a myth, isn't it, Mr. Singh? It's not there, because if it was, then I assume that last year or 2 years ago, people would have rushed to lock in for 20 years at 6.5%.
Whatever my colleagues from South Indian Bank said, though I do endorse it is there, it is mainly, I'm not criticizing anybody, but public sector banks are allowing these fixed rate loans, and it is the 3 or 4 years fixed loans are those loans which are coming.